All right. Happy Friday. A day later than we usually do these webinars. We thank you for taking the time to tune in to webinar number 10. What history tells us about presidential elections and markets. I don't know about everyone else out there, but I'm getting a little bit tired of all the same political ads running while I'm trying to watch Jeopardy. We also have Patrick on the call with us here. Patrick, good morning.
Yep, morning. If anybody has any trouble hearing Johann or viewing anything, just fire an email out to info@oceansideadvisors.com, info@oceansideadvisors.com, and I would be happy to try and be the IT guy on the other end, see if I can help out.
Perfect. Just one little change, just for today's webinar. We decided that for just today, we're not going to hold a Q&A. We just thought a Q&A might get a little bit too political and subjective. Certainly there's plenty of shows you can watch on TV to get those viewpoints. Like always, we just wanted to remain very data-driven and objective for the purpose of today's webinar. So, with that being said, certainly, like if you have questions specific to, your personal portfolio and the election, whether you work with us already or you don't, certainly feel free to reach out to us directly, and we would be happy to give you some suggestions. So we have to give a lot of credit today to Invesco and Dimensional Fund Advisors that they provided. Of course, I was doing a lot of research from some different sources, trying to prepare today's webinar, and Invesco in particular had put together some really nice slides, charts, and graphs to help provide, I think, some helpful perspective that we can share today. So, all right. Just quick disclaimer, like always, through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for informational purposes only and does not constitute financial, tax, or legal advice. Of course, we're always happy to provide this advice, but we need to get to know you and your situation a little bit better before we're allowed to do that in a fiduciary capacity. So, all right, so some questions that we will address today. Is today's environment different than past elections? Do markets perform better when a certain political party is in office? Does the sitting president matter more to stock returns than monetary policy? The policy that's set by the Federal Reserve. Is there any relationship between presidential approval ratings and equity performance? All right, so we are going to dig into these questions that I'm sure are on some of your minds. All right, so to start with, is today's environment different than past elections? And I thought this was interesting. So I'm just going to pull up two quotes. The first one, newspapers filled with all the invective that disappoint, ignorance of facts, and malicious falsehoods could invent to misrepresent my politics. Second quote here, nothing can now be believed which is seen in a newspaper. Truth itself becomes suspicious by being put into that polluted vehicle. All right, so a term we've all heard of. It sounds like some politicians concerned with fake news. And if it wasn't for maybe some of the old English choice of words in these two quotes, and maybe if we would replace newspaper with TV show or social media, you might think that these quotes were from a politician today, when in fact this first quote, George Washington. Second quote here was from Thomas Jefferson. All right, so I just thought it was kind of interesting perspective. Like, this isn't really new in terms of politicians concerned about slander, the way a certain media source is speaking about them. This has been going on for hundreds of years, and maybe today it feels a little bit more prevalent just because with today's technology, it's you have notifications popping up on your phone and on your TV all the time. Where back then it pretty much just was the newspaper. But I just thought some interesting perspective, knowing that so-called fake news it's not a new thing. So kind of along the same lines, like, is this election the most vitriolic that we've ever had? It seems so hostile and so mean, and some of these political ads are pretty extreme at times. And again, just to keep things in perspective, remember, most of us recall this from back in history class, but in 1804, sitting U.S. Vice President Aaron Burr dueled former U.S. Treasury Secretary Alexander Hamilton over political disagreements, which ultimately led to the death of Mr. Hamilton. So certainly things are hostile today, but maybe until at least at the moment, Vice President Mike Pence isn't out back dueling anyone that I'm aware of. So this is pretty extreme. Like, and of course, this is over 200 years ago. So again, just for perspective, like, politics have never been very nice. All right, so next slide we have here. So, and this is the big question. Like, we get this a lot. Do markets perform better when a certain political party is in office? All right, and like, one of my favorite things about the job that we get to do is we get to hear all kinds of differing opinions, not just in terms of politics, but like, we get to hear just about everything. And in recent months, of course, a lot of this conversation has shifted more towards politics, given the election that we have upcoming next week. And we help people that are on both sides of the political spectrum, and it puts us in an interesting position where we get to hear the concerns of both sides. Like, for example, in recent weeks, we've been hearing a lot from people. If Joe Biden gets elected, do you think we should raise more cash or shift a portfolio more conservatively? Given his tax policy might not be as friendly. And then at the same time, we get calls from people that have been sitting on a lot of cash because they don't like President Trump. And we're getting calls with people saying, hey, I've been on the sidelines for a while, and if Biden gets elected, I'm going to feel a lot more comfortable. Like, what do you think about a portfolio? And truthfully, like, both of those narratives are probably wrong. Which I think we'll try to illustrate here in the coming slides. So do markets perform better when a certain political party is in office? So here is what the growth of $100 looks like from 1929 until now. You see, of course, the presidents on the bottom. During these times, you have Republicans. Of course, they're in the red. Any Democrats are in the more bluish tint. And what hopefully you can gather from this graph is, historically speaking, markets perform pretty well regardless of who is in office. All right. And, if you take one thing away from today, maybe it's this. All right. So just this important reminder that when you're looking at financial markets, shareholders are investing in companies, that they don't invest in a political party. Right. So whether Trump wins next week or Joe Biden wins next week, like, people are still going to buy an iPhone. They're still going to shop at Amazon, or hopefully the world opens and then back at brick and mortar stores. Companies are still going to be producing goods and services that we as consumers want to consume, and we're still going to be buying food and beverages, and taking our families on trips and entertainment, the things that we enjoy. And the companies that produce these things make profits, regardless of who's in office. So just a really important reminder: shareholders invest in companies, not a political party, right? So what are some things that can impact market prices? Okay. Now, I'm not going to sit here and say like who's in office doesn't matter at all. But it's just a piece of it. It's one piece of the many things that impact financial markets, right? So, president and Congress, but you have other things like interest rates, which the president has very little control over, if any. He's not supposed to have any. You have technological advances, right? So this is a huge one. Companies, continue to innovate, and that is going to drive the economy, and that's gonna drive financial markets. You have oil prices. 2020 is a great example here. You have health crises, right? Like the coronavirus, what this has caused markets. You have corporate activity that can impact market prices. You have natural disasters. Right. So point being that, and this is just, I could list a dozen more things that drive market prices, but this is just a handful of examples. There's a lot of other things going on outside of who's in office that is impacting financial markets and equity performance. All right. So this next slide. What we're here, it's just the growth of $100 over time throughout the different presidential administrations. Here they break it out more in like a little like a plot graph. All right, where on the y-axis going north and south, this is annualized stock market performance. The x-axis is economic growth. All right, so first thing you can probably point out, like neither party can really lay a claim to superior economic or financial market performance. So you look down here, and of course, George W. Bush, in those years from 2000 to 2008, of course you have the dot-com crash, right? So the whole internet bubble exploding. You have 9/11, and then you have a financial crisis. That's I think we can all agree that that's a pretty tough hand to be dealt. And then of course Nixon, which if you go back to the previous slide, Nixon, who President Ford took over office for him after his impeachment and removal from office. So really, if you combine Ford and Nixon as one administration, you'd actually get a result that's far more favorable. But Nixon was dealing with a period of it really is a stagflationary spiral, which is not good. So as you can see, yeah, you have red and blue here, all doing just fine for the most part. All right, so here's a fun little graph, and because much like I spoke of when we started the call today, like some people only want to invest when your preferred political party is in office, and I hope this illustrates that's just not a very good idea. So here's the growth of $10,000, since 1896. I know that's a long time. But the gray graph, this is if you're fully invested regardless of who's in office, right? So you'll see that is, of the three lines sitting out there, maybe you can't even see these bottom two down here. The gray line is where I would want to be. The red line is if you're only invested while Republicans were in office. The blue line is if you're only invested while Democrats are in office. All right, and these lines were actually, amazingly, that they were side by side right until the financial crisis, where of course that market got cut in half at the end of George W. Bush's term, and then of course President Obama comes in really at the low point and got to benefit from the stock market expansion that occurred shortly thereafter. So really like neck and neck. And really this just gets down to compounding. If you cut out half of the compounding life of your investment journey, it's going to have very adverse consequences. So point here, I think we can all agree we would rather be on the gray line in terms of our investment experience than either the blue or the red line down here at the bottom. Okay, another as I was doing research on this, it was kind of fun digging into this as well. Does the sitting president or monetary policy matter more to stock returns? Okay, short answer here is that the data suggests that monetary policy plays a much bigger factor, right? So the old saying, for any of you that have watched financial markets, whether it's on CNBC or anywhere else, you've probably heard this saying, don't fight the Fed. And a lot of the data suggests that that's actually pretty good advice. The graph we have on here, I promise you it isn't quite as complex as it might appear. This blue line bouncing up and down all over the place. This is just an index of financial conditions. Okay, so it's a weighted average of a couple different factors, like interest rates and credit quality. Whereas the point of the graph here is, you'll notice that there are numerous periods of time where financial conditions were deteriorating, like declining. Things were not looking very good. And what tends to happen in periods like this are the Federal Reserve comes to the rescue. So don't fight the Fed. These are the periods of time where the Fed becomes very accommodative, which historically has benefited equity performance. All right. So, for example, in this period of time, mid to late 90s, you have the S&P up 227%. Another period of time here, kind of in the first decade of the 21st century, the S&P 500 doubled during that time. And then, of course, right after the recession of 2008-9, again, S&P up 217%. And a lot of this is just the Fed. A lot of it's the Fed helping out market conditions. So historically, presidents have been hurt or helped by monetary policy conditions. A lot of it's out of their control. For example, both presidents Reagan and Clinton benefited from consistently falling interest rates in their terms. We had both President Bushes were hurt by Fed tightening, right? So an inverted yield curve, and they both faced recessions. President Obama, of course, again, he's coming out of that recession and therefore benefited from, misspelled, okay, benefited from a benign rate environment. And then President Trump was an unfortunate recipient of some tighter policy during his first 2 years. So if you recall, he was always yelling at the Fed as the Fed was raising interest rates, in 2017, 18. And of course, now that we're in this pandemic of the coronavirus, moving forward, the Fed has been very transparent and clear that they intend to be incredibly accommodative to get us through this period of time. And so that should be a net positive to financial markets, regardless of who wins the election coming up here. Okay, I thought this next slide was just kind of fun. Is there any relationship between presidential approval ratings and equity performance? And I kind of a little off topic, but I thought it was really fun. So again, same idea here. We have the dark blue here again is just the growth of $100,000 throughout time, and then we have the in light blue we have the presidential approval ratings through time, right? So you can see going up and down throughout history, and what's pretty obvious is investors, you don't have to love what's going on in Washington, D.C. to still do well in the markets. As a matter of fact, so this kind of light blue range here, that this is periods of time where the presidential approval ratings were between 36 and 50%. Okay, so not good at those periods of time. And yet, if you look at the underlying graph, many times some of the best stock returns come when presidential approval ratings are in that range. So in other words, the market does not care whether or not you like the president, right? It's likely going to continue doing what it does. All right, so in conclusion, I wanted to keep this one short. I know it's Friday and some of you are traveling, and so in conclusion here, it's important to note that there's nothing wrong with changing your portfolio allocation as your personal circumstances change. All right, we do this for people all the time. If you're getting closer to retirement, you probably want to make changes in your portfolio to make things more conservative, safer. Maybe you're buying a house. That's if you're saving for a house, you probably don't want that money for the down payment, for example, in the market. With that being said, however, we believe changing portfolio allocation based on political elections it's likely a pretty poor decision. History is just not on your side when you're changing investment allocations based on who's in the office. And for hundreds of years, politics and investing, for whatever reason, they almost get spoken in the same breath. And you see market commentators, whether it's CNBC or any of the political news networks, really they try to link, like, I mean, I see it all the time. They try to link this performance of the stock market as some kind of like barometer of how the president's performing, and there's just 120 years of data that suggests that it's probably not a good idea, that the data just does not support it. There's too many other factors that impact equity prices and fixed income prices. You really just, you can't give a president the credit or necessarily blame them for the way markets are performing. Right, so as we've seen in the graphs, like historically, markets perform well under both political parties. It's really hard to tell ahead of time. And again, a big part of it, remember the list, like it's technological advances, like natural disasters are going to happen, pandemics are going to happen, oil prices are going to change, interest rates are going to change, the Federal Reserve is going to step in, the Federal Reserve is going to tighten at times, right, if inflation's becoming a problem. So there's a lot of things that are happening, but in the long run, we know markets tend to perform under both political parties. We know, like I just alluded to, monetary policy is going to impact stocks more than the president. All right. The CPAs over here, they're all excited that if you can hear this, they're done with tax season. They're excited. It's Friday. Lastly, the market does not care if you do not like the president, right? So again, presidential approval rating, independent of many times how the market's doing. So with that being said, we hope that this quick little webinar today might give you some decent perspective. We know that these next couple of weeks, it's scary. It's politics they can be very emotional, and what we hope that you do is just keep in perspective the big picture. Understand that the asset allocation that you have. Well, if you're working with us and we have if we have the privilege of helping you, we already have you set up in a place where we think you'll be just fine, regardless of who wins the election, and the data is on that side. So certainly if you have any questions at all pertaining to your portfolio, we would love to help and answer any questions, whether you work with us or not. But again, hopefully some of these slides have at least given you some peace of mind that it's not all the president, it's not all Congress. There's other things that impact markets, and we hope that the previous slides have helped you see that a little bit. So again, happy Friday. Thank you for tuning in to webinar number 10. We really appreciate everyone and taking time out of your busy day to listen to us for a little bit. So we hope you have a great weekend, and we'll talk to you soon. Thanks.